1957 Letter Warren E. Buffett 5202 Underwood Avenue, Omaha, Nebraska. Second Annual Letter to Limited Partners. The general stock market picture in 1957. In last year's letter to partners, I said the following: my view of the general market level is that it is priced above intrinsic value. This view relates to blue chip securities. This view, if accurate, carries with it the possibility of a substantial decline in all stock prices, both undervalued and otherwise. In any event, I think the probability is very slight that current market levels will be thought of as cheap 5 years from now. Even a full-scale bear market, however, should not hurt the market value of our workouts substantially. If the general market were to return to an undervalued status, our capital might be employed exclusively in general issues, and perhaps some borrowed money would be used in this operation at that time. Conversely, if the market should go considerably higher, our policy will be to reduce our general issues as profits present themselves and increase the workout portfolio. All of the above is not intended to imply that market analysis is foremost in my mind. Primary attention is given at all times to the detection of substantially undervalued securities. The past year witnessed a moderate decline in stock prices. I stress the word moderate, since casual reading of the press or conversing with those who have had only recent experience with stocks would tend to create an impression of a much greater decline. Actually, it appears to me that the decline in stock prices has been considerably less than the decline in corporate earning power under present business conditions. This means that the public is still very bullish on blue chip stocks and the general economic picture. I make no attempt to forecast either business or the stock market. The above is simply intended to dispel any notions that stocks have suffered any drastic decline or that the general market is at a low level. I still consider the general market to be priced on the high side based on long-term investment value. Our activities in 1957, the market decline has created greater opportunity among undervalued situations so that, generally, our portfolio is heavier in undervalued situations relative to workouts than it was last year. Perhaps an explanation of the term workout is in order. A workout is an investment which is dependent on a specific corporate action for its profit rather than a general advance in the price of the stock, as in the case of undervalued situations. Workouts come about through sales, mergers, liquidations, tenders, etc. In each case, the risk is that something will upset the apple cart and cause the abandonment of the planned action, not that the economic picture will deteriorate and stocks decline generally. At the end of 1956, we had a ratio of about 70-30 between general issues and workouts. Now it is about 85-15. During the past year, we have taken positions in two situations which have reached a size where we may expect to take some part in corporate decisions. One of these positions accounts for between 10% and 20% of the portfolio of the various partnerships, and the other accounts for about 5%. Both of these will probably take in the neighborhood of 3 to 5 years of work, but they presently appear to have potential for a high average annual rate of return with a minimum of risk. While not in the classification of workouts, they have very little dependence on the general action of the stock market. Should the general market have a substantial rise, of course, I would expect this section of our portfolio to lag behind the action of the market. Results for 1957. In 1957, the three partnerships which we formed in 1956 did substantially better than the general market. At the beginning of the year, the Dow Jones Industrials stood at 499, and at the end of the year it was at 435, for a loss of 64 points. If one had owned the averages, he would have received 22 points in dividends, reducing the overall loss to 42 points or 8.470% for the year. This loss is roughly equivalent to what would have been achieved by investing in most investment funds, and, to my knowledge, no investment fund invested in stocks showed a gain for the year. All three of the 1956 partnerships showed a gain during the year amounting to about 6.2%. 7.8% and 25% on year-end 1956 net worth. Naturally, a question is created as to the vastly superior performance of the last partnership, particularly in the mind of the partners of the first two. This performance emphasizes the importance of luck in the short run, particularly in regard to when funds are received. The third partnership was started the latest in 1956 when the market was at a lower level and when several securities were particularly attractive. Because of the availability of funds, large positions were taken in these issues. Whereas the two partnerships formed earlier were already substantially invested so that they could only take relatively small positions in these issues. Basically, all partnerships are invested in the same securities and in approximately the same percentages. However, particularly during the initial stages, money becomes available at varying times and varying levels of the market, so there is more variation in results than is likely to be the case in later years. Over the years, I will be quite satisfied with a performance that is 10% per year better than the averages. So in respect to these three partnerships, 1957 was a successful and probably better than average year. Two partnerships were started during the middle of 1957 and their results for the balance of the year were roughly the same as the performance of the averages, which were down about 12% for the period since inception of the 1957 partnerships. Their portfolios are now starting to approximate those of the 1956 partnerships, and performance of the entire group should be much more comparable in the future. Interpretation of results: to some extent our better-than-average performance in 1957 was due to the fact that it was a generally poor year for most stocks. Our performance, relatively, is likely to be better in a bear market than in a bull market, so that deductions made from the above results should be tempered by the fact that it was the type of year when we should have done relatively well. In a year when the general market had a substantial advance, I would be well satisfied to match the advance of the averages. I can definitely say that our portfolio represents better value at the end of 1957 than it did at the end of 1956. This is due to both generally lower prices and the fact that we have had more time to acquire the more substantially undervalued securities, which can only be acquired with patience. Earlier I mentioned our largest position, which comprised 10% to 20% of the assets of the various partnerships. In time I plan to have this represent 20% of the assets of all partnerships, but this cannot be hurried. Obviously, during any acquisition period, our primary interest is to have the stock do nothing or decline rather than advance. Therefore, at any given time, a fair proportion of our portfolio may be in the sterile stage. This policy, while requiring patience, should maximize long-term profits. 2. I have tried to cover points which I felt might be of interest and disclose as much of our philosophy as may be imparted without talking of individual issues. If there are any questions concerning any phase of the operation, I would welcome hearing from you. 3. 1958 Letter: Warren E. Buffett, 5202 Underwood Avenue, Omaha, Nebraska. The general stock market in 1958. A friend who runs a medium-sized investment trust recently wrote, "The mercurial temperament, characteristic of the American people, produced a major transformation in 1958, and exuberant would be the proper word for the stock market, at least." I think this summarizes the change in psychology dominating the stock market in 1958 at both the amateur and professional levels. During the past year, almost any reason has been seized upon to justify investing in the market. There are undoubtedly more mercurially tempered people in the stock market now than for a good many years, and the duration of their stay will be limited to how long they think profits can be made quickly and effortlessly. While it is impossible to determine how long they will continue to add numbers to their ranks and thereby stimulate rising prices, I believe it is valid to say that the longer their visit, the greater the reaction from it. I make no attempt to forecast the general market. My efforts are devoted to finding undervalued securities. However, I do believe that widespread public belief in the inevitability of profits from investment in stocks will lead to eventual trouble. Should this occur, prices, but not intrinsic values in my opinion, of even undervalued securities can be expected to be substantially affected. Results in 1958. In my letter of last year, I wrote, "Our performance, relatively, is likely to be better in a bear market than in a bull market, so that deductions made from the above results should be tempered by the fact that it was the type of year when we should have done relatively well. In a year when the general market had a substantial advance, I would be well satisfied to match the advance of the averages. The latter sentence describes the type of year we had in 1958 and my forecast worked out. The Dow Jones Industrial Average advanced from 435 to 583 which, after adding back dividends of about 20 points, gave an overall gain of 38.5% from the Dow Jones unit. The 5 partnerships that operated throughout the entire year obtained results averaging slightly better than this 38.5%. Based on market values at the end of both years, their gains ranged from 36.7% to 46.2%. Considering the fact that a substantial portion of assets has been and still is invested in securities, which benefit very little from a fast-rising market, I believe these results are reasonably good. I will continue to forecast that our results will be above average in a declining or level market, but it will be all we can do to keep pace with a rising market. Typical situation. So that you may better understand our method of operation, I think it would be well to review a specific activity of 1958. Last year I referred to our largest holding, which comprised 10% to 20% of the assets of the various partnerships. I pointed out that it was to our interest to have this stock decline or remain relatively steady, so that we could acquire an even larger position, and that for this reason such a security would probably hold back our comparative performance in a bull market. This stock was the Commonwealth Trust Company of Union City, New Jersey. At the time we started to purchase the stock, it had an intrinsic value $125 per share computed on a conservative basis. However, for good reasons, it paid no cash dividend at all despite earnings of about $10 per share, which was largely responsible for a depressed price of about $50 per share. So here we had a very well-managed bank with substantia 1 earnings power selling at a large discount from intrinsic value. Management was friendly to us as new stockholders and risk of any ultimate loss seemed minimal. Commonwealth was 25.5% owned by a larger bank. Commonwealth had assets of about $50 million, about half the size of the First National in Omaha, which had desired a merger for many years. Such a merger was prevented for persona 1 reasons, but there was evidence that this situation would not continue indefinitely. Thus we had a combination of 1. Very strong defensive characteristics, 2. Good solid value building up at a satisfactory pace, and 3. Evidence to the effect that eventually this value would be unlocked, although it might be 1 year or 10 years. If the latter were true, the value would presumably have been built up to a considerably larger figure, say, $250 per share. Over a period of a year or so, we were successful in obtaining about 12% of the bank at a price averaging about $51 per share. Obviously, it was definitely to our advantage to have the stock remain dormant in price. Our block of stock increased in value as its size grew, particularly after we became the second largest stockholder with sufficient voting power to warrant consultation on any merger proposa 1. Commonwealth only had about 300 stockholders and probably averaged 2 trades or so per month, so you can understand why I say that the activity of the stock market generally had very little effect on the price movement of some of our holdings. Unfortunately, we did run into some competition on buying, which railed the price to about $65 where we were neither buyer nor seller. Very small buying orders can create price changes of this magnitude in an inactive stock, which explains the importance of not having any leakage regarding our portfolio holdings. Late in the year we were successful in finding a special situation where we could become the largest holder at an attractive price, so we sold our block of Commonwealth obtaining $80 per share, although the quoted market was about 20% lower at the time. It is obvious that we could still be sitting with $50 stock patiently buying in dribs and drabs, and I would be quite happy with such a program, although our performance relative to the market last year would have looked poor. The year when a situation such at Commonwealth results in a realized profit is, to a great extent, fortuitous. Thus, our performance for any single year has serious limitations as a basis for estimating long-term results. However, I believe that a program of investing in such undervalued, well-protected securities offers the surest means of long-term profits in securities. I might mention that the buyer of the stock at $80 can expect to do quite well over the years. However, the relative undervaluation at $80 with an intrinsic value $135 is quite different from a price $50 with an intrinsic value of $125, and it seemed to me that our capital could better be employed in the situation which replaced it. This new situation is somewhat larger than Commonwealth and represents about 25% of the assets of the various partnerships. While the degree of undervaluation is no greater than in many other securities we own, or even than some, we are the largest stockholder, and this has substantial advantages many times in determining the length of time required to correct the undervaluation. In this particular holding, we are virtually assured of a performance better than that of the Dow Jones for the period we hold it. The current situation: the higher the level of the market, the fewer the undervalued securities, and I am finding some difficulty in securing an adequate number of attractive investments. I would prefer to increase the percentage of our assets in workouts, but these are very difficult to find on the right terms. To the extent possible, therefore, I am attempting to create my own workouts by acquiring large positions in several undervalued securities. Such a policy should lead to the fulfillment of my earlier forecast, an above-average performance in a bear market. It is on this basis that I hope to be judged. If you have any questions, feel free to ask them. Warren E. Buffett 2-11-59-6-1959 Letter Warren E. Buffett 5202 Underwood Avenue, Omaha, Nebraska. The general stock market in 1959. The Dow Jones Industrial Average, undoubtedly the most widely used index of stock market behavior, presented a somewhat faulty picture in 1959. This index recorded an advance from 583 to 679, or 16.4% for the year. When the dividends which would have been received through ownership of the average are added, an overall gain of 19.9% indicated for 1959. Despite this indication of a robust market, more stocks declined than advanced on the New York Stock Exchange during the year by a margin of 710 to 628. Both the Dow Jones Railroad Average and Utility Average registered declines. Most investment trusts had a difficult time in comparison with the industrial average. Tri-Continental Corp., the nation's largest closed-end investment company, total asset $400 million, had an overall gain of about 5.7% for the year. Fred Brown, its president, had this to say about the 1959 market in a recent speech to the Analysts Society. But, even though we like the portfolio, the market performance of Tri-Continental's holdings in 1959 was disappointing to us. Markets in which investor sentiment and enthusiasm play so large a part as those of 1959 are difficult for investment managers trained in values and tuned to investing for the long term. Perhaps we haven't had our space boots adjusted properly. However, we believe that there is a limit to risks that an investing institution such as Tri-Continental should take with its stockholders' money, and we believe that the portfolio is in shape for the year ahead. Massachusetts Investors Trust, the country's largest mutual fund with assets of $1.5 billion, showed an overall gain of about 9% for the year. Most of you know I have been very apprehensive about general stock market levels for several years. To date, this caution has been unnecessary. By previous standards, the present level of blue-chip security prices contains a substantial speculative component with a corresponding risk of loss. Perhaps other standards of valuation are evolving which will permanently replace the old standard. I don't think so. I may very well be wrong. However, I would rather sustain the penalties resulting from over-conservatism than face the consequences of error, perhaps with permanent capital loss, resulting from the adoption of a new era philosophy where trees really do grow to the sky. Results in 1959. There has been emphasis in previous letters on a suggested standard of performance involving relatively good results, compared to the general market indices and leading investment trusts, in periods of declining or level prices but relatively unimpressive results in rapidly rising markets. We were fortunate to achieve reasonably good results in 1959. The 6 partnerships that operated throughout the year achieved overall net gains ranging from 22.3% to 30.0%, and averaging about 25.9%. Portfolios of these partnerships are now about 80% comparable, but there is some difference due to securities and cash becoming available at varying times, payments made to partners, etc. Over the past few years, there hasn't been any partnership which has consistently been at the top or bottom of performance from year to year, and the variance is narrowing as the portfolios tend to become comparable. 7. The overall net gain is determined on the basis of market values at the beginning and end of the year adjusted for payments made to partners or contributions received from them. It is not based on actual realized profits during the year, but is intended to measure the change in liquidating value for the year. It is before interest allowed to partners, where that is specified in the partnership agreement, and before any division of profit to the general partner, but after operating expenses. The principal operating expense is the Nebraska intangibles tax, which amounts to 0.4% of market value on practically all securities. Last year represented the first time that this tax had been effectively enforced and, of course, penalized our results to the extent of 0.4%. The present portfolio. Last year, I mentioned a new commitment which involved about 25% of assets of the various partnerships. Presently, this investment is about 35% of assets. This is an unusually large percentage, but has been made for strong reasons. In effect, this company is partially an investment trust owing some 30 or 40 other securities of high quality. Our investment was made and is carried at a substantial discount from asset value based on market value of their securities and a conservative appraisal of the operating business. We are the company's largest stockholder by a considerable margin, and the 2 other large holders agree with our ideas. The probability is extremely high that the performance of this investment will be superior to that of the general market until its disposition, and I am hopeful that this will take place this year. The remaining 65% of the portfolio is in securities which I consider undervalued and workout operations. To the extent possible, I continue to attempt to invest in situations at least partially insulated from the behavior of the general market. This policy should lead to superior results in bear markets and average performance in bull markets. The first prediction may be subject to test this year since, at this writing, the Dow Jones Industrials have retraced over half of their 1959 advance. Should you have any questions or if I have not been clear in any respect, I would be very happy to hear from you. Warren E. Buffett 2-20-60-8-1960 Letter Warren E. Buffett 5202 Underwood Avenue, Omaha, Nebraska. The general stock market in 1960. A year ago, I commented on the somewhat faulty picture presented in 1959 by the Dow Jones Industrial Average, which had advanced from 583 to 679, or 16.4%. Although practically all investment companies showed gains for that year, less than 10% of them were able to match or better the record of the industrial average. The Dow Jones Utility Average had a small decline and the railroad average recorded a substantial one. In 1960, the picture was reversed. The industrial average declined from 679 to 616, or 9.3%. Adding back the dividends which would have been received through ownership of the average still left it with an overall loss of 6.3%. On the other hand, the utility average showed a good gain and, while all the results are not now available, my guess is that about 90% of all investment companies outperformed the industrial average. The majority of investment companies appear to have ended the year with overall results in the range of plus or minus 5%. On the New York Stock Exchange, 653 common stocks registered losses for the year while 404 showed gains. Results in 1960. My continual objective in managing partnership funds is to achieve a long-term performance record superior to that of the industrial average. I believe this average, over a period of years, will more or less parallel the results of leading investment companies. Unless we do achieve this superior performance, there is no reason for existence of the partnerships. However, I have pointed out that any superior record which we might accomplish should not be expected to be evidenced by a relatively constant advantage in performance compared to the average. Rather, it is likely that if such an advantage is achieved, it will be through better than average performance in stable or declining markets and average, or perhaps even poorer than average performance in rising markets. I would consider a year in which we declined 15% and the average 30% to be much superior to a year when both we and the average advanced 20%. Over a period of time, there are going to be good and bad years. There is nothing to be gained by getting enthused or depressed about the sequence in which they occur. The important thing is to be beating par. A 4 on a par 3 hole is not as good as a 5 on a par 5 hole, and it is unrealistic to assume we are not going to have our share of both par 3s and par 5s. The above dose of philosophy is being dispensed since we have a number of new partners this year, and I want to make sure they understand my objectives, my measure of attainment of these objectives, and some of my known limitations. With this background, it is not unexpected that 1960 was a better than average year for us. As contrasted with an overall loss of 6.3% for the industrial average, we had a 22.8% gain for the 7 partnerships operating throughout the year. Our results for the 4 complete years of partnership operation after expenses but before interest to limited partners or allocation to the general partner are: year partnerships operating entire year partnership gain Dow Jones gain 1957, 3. 10.4% minus 8.4% 1958, 5. 40.9% 38.5% 9. 1959, 6. 25.9% 19.9% 1960, 7. 22.8% minus 6.3%. It should be emphasized again that these are the net results to the partnership. The net results to the limited partners would depend on the partnership agreement that they had selected. The overall gain or loss is computed on a market-to-market basis. After allowing for any money added or withdrawn, such a method gives results based upon what would have been realized upon liquidation of the partnership at the beginning of the year and what would have been realized upon liquidation at year-end, and is different, of course, from our tax results, which value securities at cost and realize gains or losses only when securities are actually sold. On a compounded basis, the cumulative results have been: year partnership gain Dow Jones gain 1957 10.4% minus 8.4% 1958 55.6% 26.9% 1959 95.9% 52.2% 1960 140.6% 42.6%. Although 4 years is entirely too short a period from which to make deductions, what evidence there is points toward confirming the proposition that our results should be relatively better in moderately declining or static markets. To the extent that this is true, it indicates that our portfolio may be more conservatively, although decidedly less conventionally, invested than if we owned blue-chip securities. During a strongly rising market for the latter, we might have real difficulty in matching their performance. Multiplicity of partnerships. A preceding table shows that the family is growing. There has been no partnership which has had a consistently superior or inferior record compared to our group average, but there has been some variance each year despite my efforts to keep all partnerships invested in the same securities and in about the same proportions. This variation, of course, could be eliminated by combining the present partnerships into one large partnership. Such a move would also eliminate much detail and a moderate amount of expense. Frankly, I am hopeful of doing something along this line in the next few years. The problem is that various partners have expressed preferences for varying partnership arrangements. Nothing will be done without unanimous consent of partners. Advance payments. Several partners have inquired about adding money during the year to their partnership. Although an exception has been made, it is too difficult to amend partnership agreements during mid-year where we have more than one family represented among the limited partners. Therefore, in mixed partnerships an additional interest can only be acquired at the end of the year. We do accept advance payments during the year toward a partnership interest and pay interest at 6% on this payment from the time received until the end of the year. At that time, Subject to amendment of the agreement by the partners, the payment plus interest is added to the partnership capital and thereafter participates in profits and losses. Sanborn Map. 10 last year mention was made of an investment which accounted for a very high and unusual proportion, 35%, of our net assets, along with the comment that I had some hope this investment would be concluded in 1960. This hope materialized. The history of an investment of this magnitude may be of interest to you. Sanborn Map Company is engaged in the publication and continuous revision of extremely detailed maps of all cities of the United States. For example, the volumes mapping Omaha would weigh perhaps 50 pounds and provide minute details on each structure. The map would be revised by the paste-over method showing new construction, changed occupancy, new fire protection facilities, changed structural materials, etc. These revisions would be done approximately annually, and a new map would be published every 20 or 30 years when further pastovers became impractical. The cost of keeping the map revised to an Omaha customer would run around $100 per year. This detailed information showing diameter of water mains underlying streets, location of fire hydrants, composition of roof, etc., was primarily of use to fire insurance companies. Their underwriting departments, located in a central office, could evaluate business by agents nationally. The theory was that a picture was worth 1,000 words, and such evaluation would decide whether the risk was properly rated, the degree of conflagration exposure in an area, advisable reinsurance procedure, etc. The bulk of Sanborn's business was done with about 30 insurance companies, although maps were also sold to customers outside the insurance industry such as public utilities, mortgage companies, and taxing authorities. For 75 years the business operated in a more or less monopolistic manner, with profits realized in every year accompanied by almost complete immunity to recession and lack of need for any sales effort. In the earlier years of the business, the insurance industry became fearful that Sanborn's profits would become too great and placed a number of prominent insurance men on Sanborn's board of directors to act in a watchdog capacity. In the early 1950s, a competitive method of underwriting known as carding made inroads on Sanborn's business, and after-tax profits of the map business fell from an average annual level of over $500,000 in the late 1930s to under $100,000 in 1958 and 1959. Considering the upward bias in the economy during this period, this amounted to an almost complete elimination of what had been sizable, stable earning power. However, during the early 1930s, Sanborn had begun to accumulate an investment portfolio. There were no capital requirements to the business, so that any retained earnings could be devoted to this project. Over a period of time, about $2.5 million was invested, roughly half in bonds and half in stocks. Thus, in the last decade particularly, the investment portfolio blossomed while the operating map business wilted. Let me give you some idea of the extreme divergence of these two factors. In 1938, when the Dow Jones Industrial Average was in the 100 to 120 range, Sanborn sold at $110 per share. In 1958, with the average in the 550 area, Sanborn sold at $45 per share. Yet during that same period the value of the Sanborn investment portfolio increased from about $20 per share to $65 per share. This means, in effect, that the buyer of Sanborn stock in 1938 was placing a positive valuation of $90 per share on the map business, $110 less the $20 value of the investments unrelated to the map business, in a year of depressed business and stock market conditions. In the tremendously more vigorous climate of 1958, the same map business was evaluated at a -$20, with the buyer of the stock unwilling to pay more than 70 cents on the dollar for the investment portfolio, with the map business thrown in for nothing. How could this come about? Sanborn in 1958 as well as 1938 possessed a wealth of information of substantial value to the insurance industry. To reproduce the detailed information they had gathered over the years would have cost tens of millions of dollars. Despite carding, over $500 million of fire premiums were underwritten 11 by mapping companies. However, the means of selling and packaging Sanborn's product, information had remained unchanged throughout the year, and finally this inertia was reflected in the earnings. The very fact that the investment portfolio had done so well served to minimize in the eyes of most directors the need for rejuvenation of the map business. Sanborn had a sales volume of about $2 million per year and owned about $7 million worth of marketable securities. The income from the investment portfolio was substantial. The business had no possible financial worries. The insurance companies were satisfied with the price paid for maps, and the stockholders still received dividends. However, these dividends were cut 5 times in 8 years, although I could never find any record of suggestions pertaining to cutting salaries or directors and committee fees. Prior to my entry on the board, of the 14 directors, 9 were prominent men from the insurance industry who combined held 46 shares of stock out of 105,000 shares outstanding. Despite their top positions with very large companies which would suggest the financial wherewithal to make at least a modest commitment, the largest holding in this group was 10 shares. In several cases, the insurance companies these men ran owned small blocks of stock, but these were token investments in relation to the portfolios in which they were held. For the past decade, the insurance companies had been only sellers in any transactions involving Sanborn stock. The 10th director was the company attorney, who held 10 shares. The 11th was a banker with 10 shares who recognized the problems of the company, actively pointed them out, and later added to his holdings. The next 2 directors were the top officers of Sanborn who owned about 300 shares combined. The officers were capable, aware of the problems of the business, but kept in a subservient role by the board of directors. The final member of our cast was a son of a deceased president of Sanborn. The widow owned about 15,000 shares of stock. In late 1958, the son, unhappy with the trend of the business, demanded the top position in the company, was turned down, and submitted his resignation, which was accepted. Shortly thereafter, we made a bid to his mother for her block of stock, which was accepted. At the time there were 2 other large holdings, one of about 10,000 shares, dispersed among customers of a brokerage firm, and one of about 8,000. These people were quite unhappy with the situation and desired a separation of the investment portfolio from the map business, as did we. Subsequently, our holdings, including associates, were increased through open market purchases to about 24,000 shares, and the total represented by the 3 groups increased to 46,000 shares. We hoped to separate the 2 businesses, realize the fair value of the investment portfolio, and work to re-establish the earning power of the map business. There appeared to be a real opportunity to multiply map profits through utilization of Sanborn's wealth of raw material in conjunction with electronic means of converting this data to the most usable form for the customer. There was considerable opposition on the board to change of any type, particularly when initiated by an outsider, although management was in complete accord with our plan, and a similar plan had been recommended by Booz, Allen and Hamilton, management experts. To avoid a proxy fight, which very probably would not have been forthcoming and which we would have been certain of winning, and to avoid time delay with a large portion of Sanborn's money tied up in blue-chip stocks which I didn't care for at current prices, a plan was evolved taking out all stockholders at fair value who wanted out. The SEC ruled favorably on the fairness of the plan. About 72% of the Sanborn stock, involving 50% of the 1,600 stockholders, was exchanged for portfolio securities at fair value. The map business was left with over $25 million in government and municipal bonds as a reserve fund, and a potential corporate capital gains tax of over $1 million was eliminated. The remaining stockholders were left with a slightly improved asset value, substantially higher earnings per share, and an increased dividend rate. 12 Necessarily, the above little melodrama is a very abbreviated description of this investment operation. However, it does point up the necessity for secrecy regarding our portfolio operations, as well as the futility of measuring our results over a short span of time such as a year. Such control situations may occur very infrequently. Our bread and butter business is buying undervalued securities and selling when the undervaluation is corrected, along with investment in special situations where the profit is dependent on corporate rather than market action. To the extent that partnership funds continue to grow, it is possible that more opportunities will be available in control situations. The auditors should be mailing your financial statement and tax information within about a week. 1960 letter Buffett Partnership, Limited. 810 Kiewit Plaza, Omaha 31, Nebraska, July, 1961. To my partners. In the past, partners have commented that a once-a-year letter was a long time between drinks, and that a semi-annual letter would be a good idea. It really shouldn't be too difficult to find something to say twice a year. At least it isn't this year. Hence, this letter, which will be continued in future years. During the first half of 1961, the overall gain of the Dow Jones Industrial Average was about 13%, including dividends. Although this is the type of period when we should have the most difficulty in exceeding this standard, all partnerships that operated throughout the 6 months did moderately better than the average. Partnerships formed during 1961 either equaled or exceeded results of the average from the time of formation, depending primarily on how long they were in operation. Let me, however, emphasize 2 points. First, 1 year is far too short a period to form any kind of an opinion as to investment performance, and measurements based upon 6 months become even more unreliable. One factor that has caused some reluctance on my part to write semi-annual letters is the fear that partners may begin to think in terms of short-term performance, which can be most misleading. My own thinking is much more geared to 5-year performance, preferably with tests of relative results in both strong and weak markets. The second point I want everyone to understand is that if we continue in a market which advances at the pace of the first half of 1961, not only do I doubt that we will continue to exceed the results of the DJIA, but it is very likely that our performance will fall behind the average. Our holdings, which I always believe to be on the conservative side compared to general portfolios, tend to grow more conservative as the general market level rises. At all times, I attempt to have a portion of our portfolio in securities at least partially insulated from the behavior of the market, and this portion should increase as the market rises. However appetizing results for even the amateur cook, and perhaps particularly the amateur, we find that more of our portfolio is not on the stove. We have also begun open market acquisition of a potentially major commitment which I, of course, hope does nothing market-wise for at least a year. Such a commitment may be a deterrent to short-range performance, but it gives strong promise of superior results over a several-year period combined with substantial defensive characteristics. Progress has been made toward combining all partners at year-end. I have talked with all partners joining during this past year or so about this goal, and have also gone over the plans with representative partners of all earlier partnerships. Some of the provisions will be a merger of all partnerships, based on market value at year-end, with provisions for proper allocation among partners of future tax liability due to unrealized gains at year-end. The merger itself will be tax-free, and will result in no acceleration of realization of profits. 14. B. A division of profits between the limited partners and general partner, with the first 6% per year to partners based upon beginning capital at market, and any excess divided 1/4 to the general partner and 3/4 to all partners proportional to their capital. Any deficiencies in earnings below the 6% would be carried forward against future earnings, but would not be carried back. Presently, there are 3 profit arrangements which have been optional to incoming partners: interest provision excess to general, partner excess to limited, partners 1, 6% 1, 3 2/3 2, 4% 1, 4 3/4, 3, none 1, 6 5/6 in the event of profits. The new division will obviously have to be better for limited partners than the first 2 arrangements. Regarding the third, the new arrangement will be superior up to 18% per year, but above this rate the limited partners would do better under the present agreement. About 80% of total partnership assets have selected the first 2 arrangements, and I am hopeful, should we average better than 18% yearly, partners presently under the third arrangement will not feel short-changed under the new agreement. C. In the event of losses, there will be no carryback against amounts previously credited to me as general partner, although there will be a carry forward against future excess earnings. However, My wife and I will have the largest single investment in the new partnership, probably about 1/6 of total partnership assets, and thereby a greater dollar stake in losses than any other partner of family group. I am inserting a provision in the partnership agreement which will prohibit the purchase by me or my family of any marketable securities. In other words, the new partnership will represent my entire investment operation in marketable securities, so that my results will have to be directly proportional to yours, subject to the advantage I obtain if we do better than 6%. D. A provision for monthly payments at the rate of 6% yearly, based on beginning of the year capital valued at market. Partners not wishing to withdraw money currently can have this credited back to them automatically as an advance payment, drawing 6%, to purchase an additional equity interest in the partnership at year-end. This will solve one stumbling block that has heretofore existed in the path of consolidation, since many partners desire regular withdrawals and others wish to plow everything back. The right to borrow during the year, up to 20% of the value of your partnership interest, at 6%, such loans to be liquidated at year-end or earlier. This will add a degree of liquidity to an investment which can now only be disposed of at year-end. It is not intended that anything but relatively permanent funds be invested in the partnership, and we have no desire to turn it into a bank. Rather, I expect this to be a relatively unused provision, which is available when something unexpected turns up, and a wait until year-end to liquidate part of all of a partner's interest would cause hardship. An arrangement whereby any relatively small tax adjustment, made in later years on the partnership's return, will be assessed directly to me. This way, we will not be faced with the problem of asking 80 people, or more, to amend their earlier return over some small matter. As it stands now, a small change, such as a decision that a dividend received by the partnership has 63% a return of capital instead of 68%, could cause a multitude of paperwork. To prevent this, any change amounting to less than $1,000 of tax will be charged directly to me. We have submitted the proposed agreement to Washington for a ruling that the merger would be tax-free, and that the partnership would be treated as a partnership under the tax laws. While all of this is a lot of work, it will make things enormously easier in the future. You might save this letter as a reference to read in conjunction with the agreement which you will receive later in the year. 15. The minimum investment for new partners is currently $25,000, but, of course, this does not apply to present partners. Our method of operation will enable the partners to add or withdraw amounts of any size, in round $100, at year-end. Estimated total assets of the partnership will be in the neighborhood of $4 million, which enables us to consider investments such as the one mentioned earlier in this letter, which we would have had to pass several years ago. This has turned out to be more of a production than my annual letter. If you have any questions, particularly regarding anything that isn't clear in my discussion of the new partnership agreement, be sure to let me know. If there are a large number of questions, I will write a supplemental letter to all partners giving the questions that arise and the answers to them. Warren E. Buffett VLB, July 22, 1961 16-1961 Letter Buffett Partnership, Limited. 810 Kiewit Plaza, Omaha 31, Nebraska, January 24, 1962. Our performance in 1961. I have consistently told partners that it is my expectation and hope, it's always hard to tell which is which, that we will do relatively well compared to the general market in down or static markets, but that we may not look so good in advancing markets. In strongly advancing markets, I expect to have real difficulty keeping up with the general market. Although 1961 was certainly a good year for the general market, and in addition, a very good year for us on both an absolute and relative basis, the expectations in the previous paragraph remain unchanged. During 1961, the general market as measured by the Dow Jones Industrial Average, hereinafter called the Dow, showed an overall gain of 22.2%, including dividends received through ownership of the Dow. The gain for all partnerships operating throughout the entire year, after all expenses of operation, but before payments to limited partners or accrual to the general partner, averaged 45.9%. The details of this gain by partnership are shown in the appendix along with results for the partnerships started during the year. We have now completed 5 full years of partnership operation, and the results of these 5 years are shown below on a year-by-year basis and also on a cumulative or compounded basis. These results are stated on the basis described in the preceding paragraph, after expenses, but before division of gains among partners or payments to partners. Year partnerships operating entire year partnership gain Dow Jones Industrials gain * 1957 310.4% minus 8.4% 1958 5 40.9% 38.5% 1959 6 25.9% 19.9% 1960 7 22.8% minus 6.3% 1961 7 45.9% 22.2% including dividends received through ownership of the Dow. On a compounded basis, the cumulative results have been: year partnership gain Dow Jones Industrials gain 1957 10.4% minus 8.4% 1957 58 55.6% 26.9% 1057 to 59 95.9% 52.2% 1957 minus 60,140.6% 42.6% 1957 minus 61,251.0% 74.3%. These results do not measure the gain to the limited partner, which of course is the figure in which you are most interested. Because of the varying partnership arrangements that have existed in the past, I have used the overall net gain, based on market values at the beginning and end of the year, to the partnership as being the fairest measure of overall performance. 17 on a pro forma basis adjusted to the division of gains entailed in our present Buffett Partnership, Limited agreement. The results would have been: year limited partners gain Dow gain 1957 9.3% minus 8.4% 1958 32.2% 38.5% 1959 20.9% 19.9% 1960 18.6% minus 6.3% 1961 35.9% 22.2% compounded 1957 9.3% minus 8.4% 1957 58 44.5% 26.9% 1957 to 59 74.7% 52.2% 1957 minus 60,107.2% 42.6% 1957 minus 61,181.6% 74.3%. A word about par. The outstanding item of importance in my selection of partners, as well as in my subsequent relations with them, has been the determination that we use the same yardstick. If my performance is poor, I expect partners to withdraw, and indeed, I should look for a new source of investment for my own funds. If performance is good, I am assured of doing splendidly, a state of affairs to which I am sure I can adjust. The rub, then, is in being sure that we all have the same ideas of what is good and what is poor. I believe in establishing yardsticks prior to the act. Retrospectively, almost anything can be made to look good in relation to something or other. I have continuously used the Dow Jones Industrial Average as our measure of par. It is my feeling that 3 years is a very minimal test of performance, and the best test consists of a period at least that long where the terminal level of the Dow is reasonably close to the initial level. While the Dow is not perfect, nor is anything else, as a measure of performance, it has the advantage of being widely known, has a long period of continuity, and reflects with reasonable accuracy the experience of investors generally with the market. I have no objection to any other method of measurement of general market performance being used, such as other stock market averages, leading diversified mutual stock funds, bank common trust funds, etc. You may feel I have established an unduly short yardstick in that it perhaps appears quite simple to do better than an unmanaged index of 30 leading common stocks. Actually, this index has generally proven to be a reasonably tough competitor. Arthur Weisenberger's classic book on investment companies lists performance for the 15 years 1946 to 60, for all leading mutual funds. There is presently over $20 billion invested in mutual funds, so the experience of these funds represents, collectively, the experience of many million investors. My own belief, though the figures are not obtainable, is that portfolios of most leading investment counsel organizations and bank trust departments have achieved results similar to these mutual funds. Weisenberger lists 70 funds in his Charts and Statistics, with continuous records since 1946. I have excluded 32 of these funds for various reasons since they were balanced funds, therefore not participating fully in the general market rise, specialized industry funds, etc. Of the 32 excluded because I felt a comparison would not be fair, 1831 did poorer than the Dow, so they were certainly not excluded to slant the conclusions below. Of the remaining 38 mutual funds whose method of operation I felt was such as to make a comparison with the Dow reasonable, 32 did poorer than the Dow, and 6 did better. The 6 doing better at the end of 1960 had assets of about $1 billion, and the 32 doing poorer had assets of about $6 minus $0.5 billion. None of the 6 that were superior beat the Dow by more than a few percentage points a year. Below I present the year-by-year results for our period of operation, excluding 1961 for which I don't have exact data, although rough figures indicate no variance from the 1957 to 60 figures, for the 2 largest common stock open-end investment companies, mutual funds, and the 2 largest closed-end investment companies, year mass. INV. Trust Investors Stock Lehman Tri-Cont. Dow Limited Partners 1957 minus 12.0%, minus 12.4%, minus 11.4%, minus 2.4%, minus 8.4%, 9.3%, 1958 44.1%, 47.6%, 40.8%, 33.2%, 38.5%, 32.2%, 1959 8.2%, 10.3%, 8.1%, 8.4%, 19.9%, 20.9%, 1960 minus 0.9%, minus 0.1%, 2.6%, 2.8%, minus 6.3%, 18.6%. From Moody's Banks and Finance Manual, 1961, compounded year mass. INV. Trust Investors Stock Lehman Tri-Cont. Dow Limited Partners 1957 minus 12.0%, minus 12.4%, minus 11.4%, minus 2.4%, minus 8.4%, 9.3%, 1957 58 26.8%, 29.3%, 24.7%, 30.0%, 26.9%, 44.5%, 1957 to 59 37.2%, 42.6%, 34.8%, 40.9%, 52.2%, 74.7%, 1957 to 60 36.0%, 42.5%, 38.3%, 44.8%, 42.6%, 107.2%. Massachusetts Investors Trust has net assets of about $1.8 billion. Investors Stock Fund about $1 billion. Tri-Continental Corporation about $0.5 billion, and Lehman Corporation about $350 million, or a total of over $3.5 billion. I do not present the above tabulations and information with the idea of indicting investment companies. My own record of investing such huge sums of money, with restrictions on the degree of activity I might take in companies where we had investments, would be no better, if as good. I present this data to indicate the Dow as an investment competitor is no pushover, and the great bulk of investment funds in the country are going to have difficulty in bettering, or perhaps even matching, its performance. Our portfolio is very different from that of the Dow. Our method of operation is substantially different from that of mutual funds. However, most partners, as all alternative to their investment in the partnership, would probably have their funds invested in a media producing results comparable to the Dow. Therefore, I feel it is a fair test of performance. Our method of operation, our avenues of investment, break down into 3 categories. These categories have different behavior characteristics, and the way our money is divided among them will have an important effect on our results, relative to the Dow in any given year. The actual percentage division among categories is to some degree planned, but to a great extent, accidental, based upon availability factors. 19. The first section consists of generally undervalued securities, hereinafter called generals, where we have nothing to say about corporate policies and no timetable as to when the undervaluation may correct itself. Over the years, this has been our largest category of investment, and more money has been made here than in either of the other categories. We usually have fairly large positions, 5% to 10% of our total assets, in each of 5 or 6 generals, with smaller positions in another 10 or 15. Sometimes these work out very fast, many times they take years. It is difficult at the time of purchase to know any specific reason why they should appreciate in price. However, because of this lack of glamour or anything pending which might create immediate favorable market action, they are available at very cheap prices. A lot of value can be obtained for the price paid. This substantial excess of value creates a comfortable margin of safety in each transaction. This individual margin of safety, coupled with a diversity of commitments, creates a most attractive package of safety and appreciation potential. Over the years, our timing of purchases has been considerably better than our timing of sales. We do not go into these generals with the idea of getting the last nickel, but are usually quite content selling out at some intermediate level between our purchase price and what we regard as fair value to a private owner. The generals tend to behave market-wise very much in sympathy with the Dow. Just because something is cheap does not mean it is not going to go down. During abrupt downward movements in the market, this segment may very well go down percentage-wise just as much as the Dow. Over a period of years, I believe the generals will outperform the Dow, and during sharply advancing years like 1961, this is the section of our portfolio that turns in the best results. It is, of course, also the most vulnerable in a declining market. Our second category consists of workouts. These are securities whose financial results depend on corporate action rather than supply and demand factors created by buyers and sellers of securities. In other words, they are securities with a timetable where we can predict, within reasonable error limits, when we will get how much and what might upset the apple cart. Corporate events such as mergers, liquidations, reorganizations, spin-offs, etc., lead to workouts. An important source in recent years has been sell-outs by oil producers to major integrated oil companies. This category will produce reasonably stable earnings from year to year, to a large extent irrespective of the course of the Dow. Obviously, if we operate throughout a year with a large portion of our portfolio in workouts, we will look extremely good if it turns out to be a declining year for the Dow or quite bad if it is a strongly advancing year. Over the years, workouts have provided our second largest category. At any given time, we may be in 10 to 15 of these, some just beginning and others in the late stage of their development. I believe in using borrowed money to offset a portion of our workout portfolio since there is a high degree of safety in this category in terms of both eventual results and intermediate market behavior. Results, excluding the benefits derived from the use of borrowed money, usually fall in the 10% to 20% range. My self-imposed limit regarding borrowing is 25% of partnership net worth. Oftentimes we owe no money, and when we do borrow, it is only as an offset against workouts. The final category is control, situations where we either control the company or take a very large position and attempt to influence policies of the company. Such operations should definitely be measured on the basis of several years. In a given year, they may produce nothing, as it is usually to our advantage to have the stock be stagnant market-wise for a long period while we are acquiring it. These situations, too, have relatively little in common with the behavior of the Dow. Sometimes, of course, we buy into a general with the thought in mind that it might develop into a control situation. If the price remains low enough for a long period, this might very well happen. If it moves up before we have a substantial percentage of the company's stock, we sell at higher levels and complete a successful general operation. We are presently acquiring stock in what may turn out to be control situations several years hence. 20 Dempster Mill Manufacturing Company. We are presently involved in the control of Dempster Mill Manufacturing Company of Beatrice, Nebraska. Our first stock was purchased as a generally undervalued security 5 years ago. A block later became available, and I went on the board about 4 years ago. In August 1961, we obtained majority control, which is indicative of the fact that many of our operations are not exactly of the overnight variety. Presently we own 70% of the stock of Dempster with another 10% held by a few associates. With only 150 or so other stockholders, a market on the stock is virtually non-existent and in any case, would have no meaning for a controlling block. Our own actions in such a market could drastically affect the quoted price. Therefore, it is necessary for me to estimate the value at year-end of our controlling interest. This is of particular importance since, in effect, new partners are buying in based upon this price, and old partners are selling a portion of their interest based upon the same price. The estimated value should not be what we hope it would be worth, or what it might be worth to an eager buyer, etc., but what I would estimate our interest would bring if sold under current conditions in a reasonably short period of time. Our efforts will be devoted toward increasing this value, and we feel there are decent prospects of doing this. Dempster is a manufacturer of farm implements and water systems with sales in 1961 of about $9 million. Operations have produced only nominal profits in relation to invested capital during recent years. This reflected a poor management situation, along with a fairly tough industry situation. Presently, consolidated net worth, book value, is about $4.5 million, or $75 per share, consolidated working capital about $50 per share, and at year-end we valued our interest at $35 per share. While I claim no oracular vision in a matter such as this, I feel this is a fair valuation to both new and old partners. Certainly, if even moderate earning power can be restored, a higher valuation will be justified, and even if it cannot, Dempster should work out at a higher figure. Our controlling interest was acquired at an average price of about $28, and this holding currently represents 21% of partnership net assets based on the $35 value. Of course, this section of our portfolio is not going to be worth more money merely because General Motors, U.S. Steel, etc., sell higher. In a raging bull market, operations in control situations will seem like a very difficult way to make money, compared to just buying the general market. However, I am more conscious of the dangers presented at current market levels than the opportunities. Control situations, along with workouts, provide a means of insulating a portion of our portfolio from these dangers. The question of conservatism. The above description of our various areas of operation may provide some clues as to how conservatively our portfolio is invested. Many people some years back thought they were behaving in the most conservative manner by purchasing medium or long-term municipal or government bonds. This policy has produced substantial market depreciation in many cases, and most certainly has failed to maintain or increase real buying power. Conscious, perhaps overly conscious, of inflation, many people now feel that they are behaving in a conservative manner by buying blue-chip securities almost regardless of price-earnings ratios, dividend yields, etc. Without the benefit of hindsight as the bond example, I feel this course of action is fraught with danger. There is nothing at all conservative, in my opinion, about speculating as to just how high a multiplier a greedy and capricious public will put on earnings. You will not be right simply because a large number of people momentarily agree with you. You will not be right simply because important people agree with you. In many quarters, the simultaneous occurrence of the two above factors is enough to make a course of action meet the test of conservatism. 21. You will be right. Over the course of many transactions, if your hypotheses are correct, your facts are correct, and your reasoning is correct. True conservatism is only possible through knowledge and reason. I might add that in no way does the fact that our portfolio is not conventional prove that we are more conservative or less conservative than standard methods of investing. This can only be determined by examining the methods or examining the results. I feel the most objective test as to just how conservative our manner of investing is arises through evaluation of performance in down markets. Preferably these should involve a substantial decline in the Dow. Our performance in the rather mild declines of 1957 and 1960 would confirm my hypothesis that we invest in an extremely conservative manner. I would welcome any partners suggesting objective tests as to conservatism to see how we stack up. We have never suffered a realized loss of more than 0.5% of 1% of total net assets, and our ratio of total dollars of realized gains to total realized losses is something like 100 to 1. Of course, this reflects the fact that on balance we have been operating in an up market. However, there have been many opportunities for loss transactions even in markets such as these. You may have found out about a few of these yourselves, so I think the above facts have some significance. The question of size aside from the question as to what happens upon my death, which with a metaphysical twist, is a subject of keen interest to me. I am probably asked most often, what effect is the rapid growth of partnership funds going to have upon performance? Larger funds tug in two directions. From the standpoint of passive investments, where we do not attempt by the size of our investment to influence corporate policies, larger sums hurt results. For the mutual fund or trust department investing in securities with very broad markets, the effect of large sums should be to penalize results only very slightly. Buying 10,000 shares of General Motors is only slightly more costly, on the basis of mathematical expectancy, than buying 1,000 or 100 shares. In some of the securities in which we deal, but not all by any means, buying 10,000 shares is much more difficult than buying 100 and is sometimes impossible. Therefore, for a portion of our portfolio, larger sums are definitely disadvantageous. For a larger portion of the portfolio, I would say increased sums are only slightly disadvantageous. This category includes most of our workouts and some generals. However, in the case of control situations, increased funds are a definite advantage. A Sanborn map cannot be accomplished without the wherewithal. My definite belief is that the opportunities increase in this field as the funds increase. This is due to the sharp fall-off in competition as the ante mounts, plus the important positive correlation that exists between increased size of company and lack of concentrated ownership of that company's stock. Which is more important, the decreasing prospects of profitability in passive investments or the increasing prospects in control investments? I can't give a definite answer to this since to a great extent it depends on the type of market in which we are operating. My present opinion is that there is no reason to think these should not be offsetting factors. If my opinion should change, you will be told. I can say, most assuredly, that our results in 1960 and 1961 would not have been better if we had been operating with the much smaller sums of 1956 and 1957. And a prediction 22 regular readers, I may be flattering myself, will feel I have left the tracks when I start talking about predictions. This is one thing from which I have always shied away and I still do in the normal sense. I am certainly not going to predict what general business or the stock market are going to do in the next year or two since I don't have the faintest idea. I think you can be quite sure that over the next 10 years there are going to be a few years when the general market is plus 20% or 25%, a few when it is minus on the same order, and a majority when it is in between. I haven't any notion as to the sequence in which these will occur, nor do I think it is of any great importance for the long-term investor. Over any long period of years, I think it likely that the Dow will probably produce something like 5% to 7% per year compounded from a combination of dividends and market value gain. Despite the experience of recent years, anyone expecting substantially better than that from the general market probably faces disappointment. Our job is to pile up yearly advantages over the performance of the Dow without worrying too much about whether the absolute results in a given year are a plus or a minus. I would consider a year in which we were down 15% and the Dow declined 25% to be much superior to a year when both the partnership and the Dow advanced 20%. I have stressed this point in talking with partners and have watched them nod their heads with varying degrees of enthusiasm. It is most important to me that you fully understand my reasoning in this regard and agree with me not only in your cerebral regions, but also down in the pit of your stomach. For the reasons outlined in my method of operation, our best years relative to the Dow are likely to be in declining or static markets. Therefore, the advantage we seek will probably come in sharply varying amounts. There are bound to be years when we are surpassed by the Dow, but if over a long period we can average 10 percentage points per year better than it, I will feel the results have been satisfactory. Specifically, if the market should be down 35% or 40% in a year, and I feel this has a high probability of occurring 1 year in the next 10. No one knows which one. We should be down only 15% or 20%. If it is more or less unchanged during the year, we would hope to be up about 10 percentage points. If it is up 20% or more, we would struggle to be up as much. The consequence of performance such as this over a period of years would mean that if the Dow produces a 5% to 7% per year overall gain compounded, I would hope our results might be 15% to 17% per year. The above expectations may sound somewhat rash, and there is no question but that they may appear very much so when viewed from the vantage point of 1965 or 1970. It may turn out that I am completely wrong. However, I feel the partners are certainly entitled to know what I am thinking in this regard, even though the nature of the business is such as to introduce a high probability of error in such expectations. In any one year, the variations may be quite substantial. This happened in 1961, but fortunately the variation was on the pleasant side. They won't all be miscellaneous. We are now installed in an office at 810 Kiewit Plaza with a first-class secretary, Beth Henley, and an associate with considerable experience in my type of securities, Bill Scott. My father is sharing office space with us. He also shares the expenses, and doing a brokerage business in securities. None of our brokerage is done through him, so we have no Vicuña coat situation. Overall, I expect our overhead, excluding interest on borrowings and Nebraska intangibles tax, to run less than 0.5 of 1% of net assets. We should get our money's worth from this expenditure, and you are most cordially invited to drop in and see how the money is being spent. 23 with over 90 partners and probably 40 or so securities, you can understand that it is quite a welcome relief to me to shake loose from some of the details. We presently have partners residing in locations from California to Vermont, and net assets at the beginning of 1962 amounted to $7,178,500. Susie and I have an interest in the partnership amounting to $1,025,000, and other relatives of mine have a combined interest totaling $782,600. The minimum for new partners last year was $25,000, but I am giving some thought to increasing it this year. Pete, Marwick, Mitchell & Company did an excellent job of expediting the audit, providing tax figures much earlier than in the past. They assure me this performance can be continued. Let me hear from you regarding questions you may have on any aspects of this letter, your audit, status of your partnership interest, etc. That may puzzle you. Cordially, Warren E. Buffett. 24 Appendix Partnerships operating throughout 1961. Partnership 1 January 61. Capital at market. Overall gain in 1961 * percentage gain. Buffett Associates 486,874.27 225,387.80 Buffett Fund 351,839.29 159,696.93 45.4% Day C 235,480.31 116,504.47 49.5% MDay 140,005.24 67,387.28 48.1% Glenoff 78,482.70 39,693.80 50.5% Mo Buff 325,844.71 149,163.7145.8%, Underwood 582,256.82, 251,951.2643.3%, 2,200,783.34, 1,09,785.2545.9%. Partnerships started in 1961. Partnership paid in overall gain in 1961. Percentage gain and investments 100,100. January 30, 61. 35,367.93, 35.3%. Buffett TD 250,100. $200,100 on the 8th of March 61. $50,000 on May 31, 61. 70,294.08, 28.1%. Buffett Holland 125,100. May 17, 61. 16,703.76, 13.3% gain in net assets at market values plus payments to limited partners during year 25. Buffett Partnership, Limited. 810 Kiewit Plaza, Omaha 31, Nebraska, July 6, 1962. A reminder. In my letter of January 24, 1962 reporting on 1961, I inserted a section entitled, "And a Prediction." While I have no desire to inflict cruel and unusual punishment upon my readers, nevertheless, a reprinting of that section, in its entirety, may be worthwhile. And a prediction. Regular readers, I may be flattering myself, will feel I have left the tracks when I start talking about predictions. This is one thing from which I have always shied away, and I still do in the normal sense. I am certainly not going to predict what general business or the stock market are going to do in the next year or two, since I don't have the faintest idea. I think you can be quite sure that over the next 10 years there are going to be a few years when the general market is plus 20% or 25%, a few when it is minus on the same order, and a majority when it is in between. I haven't any notion as to the sequence in which these will occur, nor do I think it is of any great importance for the long-term investor. Over any long period of years, I think it likely that the Dow will probably produce something like 5% to 7% per year, compounded from a combination of dividends and market value gain. Despite the experience of recent years, anyone expecting substantially better than that from the general market probably faces disappointment. Our job is to pile up yearly advantages over the performance of the Dow without worrying too much about whether the absolute results in a given year are a plus or a minus. I would consider a year in which we were down 15% and the Dow declined 25% to be much superior to a year when both the partnership and the Dow advanced 20%. I have stressed this point in talking with partners and have watched them nod their heads with varying degrees of enthusiasm. It is most important to me that you fully understand my reasoning in this regard and agree with me not only in your cerebral regions, but also down in the pit of your stomach. For the reasons outlined in my method of operation, our best years relative to the Dow are likely to be in declining or static markets. Therefore, the advantage we seek will probably come in sharply varying amounts. There are bound to be years when we are surpassed by the Dow, but if over a long period we can average 10 percentage points per year better than it, I will feel the results have been satisfactory. Specifically, if the market should be down 35% or 40% in a year, and I feel this has a high probability of occurring one year in the next 10, no one knows which one, we should be down only 15% or 20%. If it is more or less unchanged during the year, we would hope to be up about 10 percentage points. If it is up 20% or more, we would struggle to be up as much. The consequence of performance such as this over a period of years would mean that if the Dow produces a 5% to 7% per year overall gain compounded, I would hope our results might be 15% to 17% per year. 26. The above expectations may sound somewhat rash, and there is no question but that they may appear very much so when viewed from the vantage point of 1965 or 1970. It may turn out that I am completely wrong. However, I feel the partners are certainly entitled to know what I am thinking in this regard, even though the nature of the business is such as to introduce a high probability of error in such expectations. In any one year, the variations may be quite substantial. This happened in 1961, but fortunately the variation was on the pleasant side. They won't all be. The first half of 1962. Between year-end 1961 and June 30, 1962, the Dow declined from 731.14 to 561.28. If one had owned the Dow during this period, dividends of approximately $11 would have been received, so that overall a loss of 21.7% would have been the result of investing in the Dow. For the statistical-minded, Appendix A gives the results of the Dow by years since formation of the predecessor partnerships. As stated above, a declining Dow gives us our chance to shine and pile up the percentage advantages which, coupled with only an average performance during advancing markets, will give us quite satisfactory long-term results. Our target is an approximately 0.5% decline for each 1% decline in the Dow, and if achieved, means we have a considerably more conservative vehicle for investment in stocks than practically any alternative. As outlined in Appendix B, showing combined predecessor partnership results, during the first half of 1962 we had one of the best periods in our history, achieving a -7.5% result before payments to partners, compared to the -21.7% overall result on the Dow. This 14.2 percentage points advantage can be expected to widen during the second half if the decline in the general market continues, but will probably narrow should the market turn upward. Please keep in mind my continuing admonition that 6 months or even 1 year's results are not to be taken too seriously. Short periods of measurement exaggerate chance fluctuations in performance. While circumstances contributed to an unusually good first half, there are bound to be periods when we do relatively poorly. The figures for our performance involve no change in the valuation of our controlling interest in Dempster Mill Manufacturing Company, although developments in recent months point toward a probable higher realization. Investment companies during the first half. Past letters have stressed our belief that the Dow is no pushover as a yardstick for investment performance. To the extent that funds are invested in common stocks, whether the manner of investment be through investment companies, investment counselors, bank trust departments, or do it yourself, our belief is that the overwhelming majority will achieve results roughly comparable to the Dow. Our opinion is that the deviations from the Dow are much more likely to be toward a poorer performance than a superior one. To illustrate this point, we have continually measured the Dow and limited partners' results against the two largest open-end investment companies, mutual funds, following a program of common stock investment, and the two largest closed-end investment companies. The tabulation in Appendix C shows the 5 years' results, and you will note the figures are extraordinarily close to those of the Dow. These companies have total assets of about $3.5 billion. In the interest of getting this letter out promptly, we are mailing it before results are available for the closed-end companies. However, the two mutual funds both did poorer than the Dow, with Massachusetts Investors Trust having a -23% overall performance, and Investors Stock Fund realizing a -25.4%. This is not unusual, as witness the lead article in the Wall Street Journal of June 13, 1962, headed Funds vs. Market. Of the 17 large common stock funds studied, everyone had a record poorer than the Dow from the peak on the Dow of 734, to the date of the article, although in some cases the margin of inferiority was minor. 27 particularly hard hit in the first half were the so-called growth funds, which, almost without exception, were down considerably more than the Dow. The three large growth, the quotation marks are more applicable now, funds with the best record in the preceding few years, Fidelity Capital Fund, Putnam Growth Fund, and Wellington Equity Fund, averaged an overall -32.3% for the first half. It is only fair to point out that because of their excellent records in 1959 to 61, their overall performance to date is still better than average, as it may well be in the future. Ironically, however, this earlier superior performance had caused such a rush of new investors to come to them that the poor performance this year was experienced by very many more holders than enjoyed the excellent performance of earlier years. This experience tends to confirm my hypothesis that investment performance must be judged over a period of time, with such a period including both advancing and declining markets. There will continue to be both, a point perhaps better understood now than 6 months ago. In outlining the results of investment companies, I do so not because we operate in a manner comparable to them or because our investments are similar to theirs. It is done because such funds represent a public batting average of professional, highly paid investment management handling a very significant $20 billion of securities. Such management, I believe, is typical of management handling even larger sums. As an alternative to an interest in the partnership, I believe it reasonable to assume that many partners would have investments managed similarly. Asset values. The above calculations of results are before allocation to the general partner and monthly payments to partners. Of course, whenever the overall results for the year are not plus 6% on a market value basis, with deficiencies carried forward, there is no allocation to the general partner. Therefore, non-withdrawing partners have had a decrease in their market value equity during the first 6 months of 7.5%, and partners who have withdrawn at the rate of 6% per annum have had a decrease in their market value equity during the first half of 10.5%. Should our results for the year be less than plus 6%, and unless there should be a material advance in the Dow, this is very probable. Partners receiving monthly payments will have a decrease in their market value equity at December 31, 1962. This means that monthly payments at 6% on this new market equity next year will be on a proportionately reduced basis. For example, if our results were an overall minus 7% for the year, a partner receiving monthly payments who had a market value interest of $100,000 on January 1, 1962 would have an equity at December 31, 1962 of $87,000. This reduction would arise from the minus 7% result, or $7,000 plus monthly payments of $500 for an additional $6,000. Thus, with $87,000 of market equity on January 1, 1963, monthly payments next year would be $435. None of the above, of course, has any applicability to advance payments received during 1962 which do not participate in profits or losses, but earn a straight 6%. Appendix: A Dow Jones Industrial Average Year Closing Dow Change for Year Dow Dividend Overall Result from Dow Percentage Result 1956 499.47 1957 435.69 to 63.78 21.61 to 42.17 minus 8.4% 1958 583.65 147.96 20.00 167.96 38.5% 1959 679.36 95.71 20.74 116.45 20.0% 1966 115.89 63.47 21.36 42.11 to 6.2% 1961 731.14 115.25 22.61 137.86 22.4% June 30 62 561.28 169.86 11.00 est. Minus 158.86 minus 21.7% 28 Appendix B Partnership Performance Year Partnership Result 1. Limited Partners Results 2. 1957 10.4% 9.3% 1958 40.9% 32.2% 1959 25.9% 20.9% 1960 22.8% 18.6% 1961 45.9% 35.9% June 30 62 minus 7.5% minus 7.5%. 1. For 1957 to 61 consists of combined results of all predecessor limited partnerships operating throughout entire year after all expenses but before distributions to partners or allocations to the general partners. 2. for 1957 to 61 computed on basis of preceding column of partnership results allowing for allocation to general partner based upon present partnership agreement. Appendix C yearly results year mass. INV. Trust. 1. Investors stock. 1. Lehman. 2. Tricont. 2. 1957 minus 11.4% minus 12.4% minus 11.4% minus 2.4% 1958 42.7% 47.5% 40.8% 33.2% 1959 9.0% 10.3% 8.1% 8.4% 1960 minus 1.0% minus 0.6% 2.5%, 2.8%, 1961, 25.6%, 24.9%, 23.6%, 22.5%, June 30, 92, 23.0%, minus 25.4%, NANA. 1. Computed from changes in asset value plus any distributions to holders of record during year. 2. From Moody's Bank and Finance Manual 1962. Cumulative results years mass. INV. Trust investors stock Lehman Tricont. Dow Limited Partners 1957 minus 11.4% minus 12.4% minus 11.4% minus 2.4% minus 8.4% 9.3% 1957 58 26.4%, 29.2%, 24.7%, 30.0%, 26.9%, 44.5%, 1957 to 59 37.8%, 42.5%, 34.8%, 40.9%, 52.3%, 74.7%, 1957 to 60 36.4%, 41.6%, 38.2%, 44.8%, 42.9%, 107.2 1957 to 61 71.4%, 76.9%, 70.8%, 77.4%, 74.9%, 181.6 1957 June 30, 62 31.9%, 32.0%, NANA 37.0%, 160.5%, 29 Buffett Partnership Limited. 810 Kiewit Plaza Omaha 31, Nebraska November 1, 1962 to my partners for 1963. Here we go on the annual paper flurry. 2 copies of an amended partnership agreement for 1963 are enclosed. The one with the general provisions attached is to be kept by you and the other single-page agreement should be returned. There are no substantive changes of any sort from last year's agreement. This amendment is merely to allow for a few new partners and in several places to reword in clearer, we hope, language provisions of the present agreement. Practically all of the rewording is in General Provision 5, Paragraph 7 in last year's agreement. Rather than have a separate amending document, we have incorporated the changes into one complete document embodying the entire agreement. We are also enclosing 2 commitment letters, one for you, one to be returned, on which you are to indicate your wishes regarding additions or withdrawals at January 1. We would like to have the agreement and the commitment letter back by December 1. However, the commitment letter can be amended right up until the end of the year, not after, so if you should have a change of plans and you have already mailed us your commitment letter, all you have to do is get in touch with me, and I will make whatever changes you desire. Any withdrawals will be paid immediately after January 1. Any additions must reach us by January 10, and should they be paid in during November, they will take on the status of advance payments and draw interest at the rate of 6% until year-end. Please be sure the signature on your partnership agreement is notarized. Partners in Omaha may obtain the notarization at our office if they wish. Also, be sure to let us know by an appropriate circle on the commitment letter whether you wish to receive monthly payments in 1963. In order to be sure everyone understands this, let me again state that these monthly payments are in no sense guaranteed earnings or anything of the sort. They represent a convenient form of regular withdrawal, which to the extent we earn better than 6% are payments from earnings, and to the extent we don't, are payments from capital. Complete tax information for your 1962 return will be in your hands by January 20th. If you should need an estimate of your tax position before that time, let me know and I will give you a rough idea. We will also send out a short letter on taxes in late December. Having read this far, you are entitled to a report on how we have done to date in 1962. For the period ending October 31st, the Dow Jones Industrials showed an overall loss, including dividends received, of approximately 16.8%. We intend to use the same method of valuing our controlling interest in Dempster Mill Manufacturing at this year-end that we did at the end of last year. This involved applying various discounts to the balance sheet items to reflect my opinion as to what could be realized on a very prompt sale. Last year this involved a 40% discount on inventories, a 15% discount on receivables, estimated auction value of fixed assets, etc., which led to an approximate value of $35 per share. The successful conversion of substantial portions of the assets of Dempster to cash, at virtually 100 cents on the dollar, has been the high point of 1962. For example, inventory of $4.2 million at last year-end will probably be about $1.9 million this year-end, reducing the discount on this item by about $920,000, 40% of $2.3 million reduction. I will give this story my full journalistic treatment in my annual letter. Suffice to say at this point that applying the same discounts described above will probably result in a year-end value of at least $50 per share. The extent of the asset conversion job can perhaps best be illustrated in a sentence by pointing out that whereas we had $166,000 of cash and $2,315,000 of liabilities at November 30, 1961, Dempster fiscal year end, we expect this year to have about $1 million in cash and investments, of the type the partnership buys, against total liabilities of $250,000. Prospects for further improvement in this situation in 1963 appear good, and we expect a substantially expanded investment portfolio in Dempster next year. Valuing Dempster at $50 per share, our overall gain, before any payments to partners, to October 31st for the partnership has been 5.5%. This 22.3 percentage points advantage over the Dow, if maintained until the end of the year, will be among the largest we have ever had. About 60% of this advantage was accomplished by the portfolio other than Dempster, and 40% was the result of increased value at Dempster. I want all partners and prospective partners to realize the results described above are distinctly abnormal and will recur infrequently, if at all. This performance is mainly the result of having a large portion of our money in controlled assets and workout situations rather than general market situations at a time when the Dow declined substantially. If the Dow had advanced materially in 1962, we could have looked very bad on a relative basis, and our success to date in 1962 certainly does not reflect any ability on my part to guess the market. I never try. But merely reflects the fact that the high prices of generals partially forced me into other categories or investment. If the Dow had continued to soar, we would have been low man on the totem pole. We fully expect to have years when our method of operation will not even match the results of the Dow, although obviously I don't expect this on any long-term basis or I would throw in the towel and buy the Dow. I'll cut this sermon short with the conclusion that I certainly do not want anyone to think that the pattern of the last few years is likely to be repeated. I expect future performance to reflect much smaller advantages on average over the Dow. Each letter ends with the request that you let me know about anything that isn't clear. Please be sure that you do this. We are all geared up with secretarial help, a new typewriter, etc., and we want to be sure that this letter and agreement are understood by all. Cordially, Warren E. Buffett Webb. BFP, S. There are no prizes for being the last ones to get in the agreement and commitment letter, so please get to it as soon as possible. Remember, the commitment letter can be amended by a postcard or a phone call. We are just trying to get the bulk of the work out of the way well before December 31st so we can concentrate on getting the audit, tax information, etc., out pronto at year-end. 3. Buffett Partnership, Limited. 810 Kiewit Plaza, Omaha 31, Nebraska, January 18, 1963. The ground rules. Some partners have confessed, that's the proper word, that they sometimes find it difficult to wade through my entire annual letter. Since I seem to be getting more long-winded each year, I have decided to emphasize certain axioms on the first pages. Everyone should be entirely clear on these points. To most of you, this material will seem unduly repetitious, but I would rather have 9 partners out of 10 mildly bored than have 1 out of 10 with any basic misconceptions. 1. In no sense is any rate of return guaranteed to partners. Partners who withdraw 0.5% monthly are doing just that, withdrawing. If we earn more than 6% per annum over a period of years, the withdrawals will be covered by earnings and the principal will increase. If we don't earn 6%, the monthly payments are partially or wholly a return of capital. 2. Any year in which we fail to achieve at least a plus 6% performance will be followed by a year when partners receiving monthly payments will find those payments lowered. 3. Whenever we talk of yearly gains or losses, we are talking about market values. That is, how we stand with assets valued at market at year-end against how we stood on the same basis at the beginning of the year. This may bear very little relationship to the realized results for tax purposes in a given year. 4. Whether we do a good job or a poor job is not to be measured by whether we are plus or minus for the year. It is instead to be measured against the general experience in securities as measured by the Dow Jones Industrial Average, leading investment companies, etc. If our record is better than that of these yardsticks, we consider it a good year whether we are plus or minus. If we do poorer, we deserve the tomatoes. 5. While I much prefer a 5-year test, I feel 3 years as an absolute minimum for judging performance. It is a certainty that we will have years when the partnership performance is poorer, perhaps substantially so, than the Dow. If any 3-year or longer period produces poor results, we all should start looking around for other places to have our money. An exception to the latter statement would be 3 years covering a speculative explosion in a bull market. 6. I am not in the business of predicting general stock market or business fluctuations. If you think I can do this, or think it is essential to an investment program, you should not be in the partnership. 7. I cannot promise results to partners. What I can and do promise is that a. Our investments will be chosen on the basis of value, not popularity. b. That we will attempt to bring risk of permanent capital loss, not short-term quotational loss, to an absolute minimum by obtaining a wide margin of safety in each commitment and a diversity of commitments, and c. My wife, children and I will have virtually our entire net worth invested in the partnership. 32. Our performance in 1962. I have consistently told partners that we expect to shine on a relative basis during minus years for the Dow, whereas plus years of any magnitude may find us blushing. This held true in 1962. Because of a strong rally in the last few months, the general market as measured by the Dow really did not have such a frightening decline as many might think. From 731 at the beginning of the year, it dipped to 535 in June, but closed at 652. At the end of 1960, the Dow stood at 616, so you can see that while there has been a good deal of action the past few years, the investing public as a whole is not too far from where it was in 1959 or 1960. If one had owned the Dow last year, and I imagine there are a few people playing the high flyers of 1961 who wish they had, they would have had a shrinkage in market value of 79.04 or 10.8%. However, dividends of approximately 23.30 would have been received to bring the overall results from the Dow for the year to minus 7.6%. Our own overall record was plus 13.9%. Below we show the year-by-year performance of the Dow, the partnership before allocation to the general partner, and the limited partners' results for all full years of Buffett Partnership, Limited's and predecessor partnerships' activities. Year overall results from Dow Partnership results. 1. Limited Partners results 2. 1957.
8.4%, 10.4%, 9.3%, 1958 38.5%, 40.9%, 32.2%, 1959 20.0%, 25.9%, 20.9%, 1960-6.2%, 22.8%, 18.6%, 1961 22.4%, 45.9%, 35.9%, 1962-7.6%, 13.9%, 11.9%. 1. For 1957 to 61 consists of combined results of all predecessor limited partnerships operating throughout entire year after all expenses but before distributions to partners or allocations to the general partner.
2. For 1957 to 61 computed on basis of preceding column of partnership results allowing for allocation to general partner based upon present partnership agreement. The following table shows the cumulative or compounded results in the same three categories, as well as the average annual compounded rate. Year overall results from Dow Partnership Results Limited Partners Results 1957 -8.4%, 10.4%, 9.3%, 1957, 58, 26.9%, 55.6%, 44.5%, 1957 to 59, 52.3%, 95.9%, 74.7%, 1957 to 60, 42.9%, 140.6%, 107.2%, 1957 to 61, 74.9%, 251.0%, 181.6%, 1957 to 62, 61.6%, 299.8%, 215.1%, annual compounded rate 8.3%, 26.0%, 21.1%. My unscientific opinion is that a margin of 10 percentage points per annum over the Dow is the very maximum that can be achieved with invested funds over any long period of years, so it may be well to mentally modify some of the above figures. Partners have sometimes expressed concern as to the effect of size upon performance. This subject was reflected upon in last year's annual letter. The conclusion reached was that there were some situations where larger sums 33 helped and some where they hindered, but on balance, I did not feel they would penalize performance. I promised to inform partners if my conclusions on this should change. At the beginning of 1957, combined limited partnership assets totaled $303,726 and grew to $7,178,500 at the beginning or 1962. To date, anyway, our margin over the Dow has indicated no tendency to narrow as funds increase. Investment companies along with the results of the Dow, we have regularly included the tabulations on the two largest open-end investment companies, mutual funds, following a common stock policy, and the two largest diversified closed-end investment companies. These four companies, Massachusetts Investors Trust, Investors Stock Fund, Tri-Continental Corp., and Lehman Corp., manage over $3 billion and are probably typical of most of the $20 billion investment company industry. My opinion is that their results parallel those of most bank trust departments and investment counseling organizations which handle, in aggregate, vastly greater sums. The purpose of this tabulation, which is shown below, is to illustrate that the Dow is no pushover as an index of investment achievement. The advisory talent managing just the four companies shown commands annual fees of approximately $7 million, and this represents a very small fraction of the industry. Nevertheless, the public batting average of this highly paid talent indicates results slightly less favorable than the Dow. In no sense is this statement intended as criticism. Within their institutional framework and handling the many billions of dollars involved, I consider such average results virtually the only possible ones. Their merits lie in other than superior results. Both our portfolio and method of operation differ substantially from the companies mentioned above. However, most partners, as an alternative to their interest in the partnership, would probably have their funds invested in media producing results comparable with investment companies, and I, therefore, feel they offer a meaningful test of performance. Year Mass. INV. Trust. 1. Investors Stock. 1. Lehman. 2. Tricont.
2. Dow Limited Partners 1957 -11.4% -12.4% -11.4% -2.4% -8.4% 9.3% 1958 42.7% 47.5% 40.8% 33.2% 38.5% 32.2% 1959 9.0% 10.3% 8.1% 8.4% 20.0%, 20.9%, 1960 -1.0%, -0.6%, 2.5%, 2.8%, -6.2%, 18.6%, 1961 25.6%, 24.9%, 23.6%, 22.5%, 22.4%, 35.9%, 1962 -9.8%, -13.4%, -13.0%, -10.0%, -7.6%, 11.9%. 1. Computed from changes in asset value plus any distributions to holders of record during year.
2. From 1962 Moody's Bank and Finance Manual for 1957 to 61. Estimated for 1962. Compounded year mass. INV. Trust Investor Stock Lehman Tricont.
Dow Limited Partners 1957 -11.4% -12.4% -11.4% -2.4% -8.4% 9.3% 1957 58 26.4% 29.2% 24.7% 30.0% 26.9% 44.5% 1957 to 59 37.8% 42.5% 34.8%, 40.9%, 52.3%, 74.7%, 1957 to 60 36.4%, 41.6%, 38.2%, 44.8%, 42.9%, 107.2%, 1957 to 61 71.3%, 76.9%, 70.8%, 77.4%, 74.9%, 181.6%, 1957 to 62 54.5%, 53.2%, 48.6%, 59.7%, 61.6%, 215.1%, 34 annual compounded rate 7.5%, 7.4%, 6.8%, 8.1%, 8.3%, 21.1%. The joys of compounding. I have it from unreliable sources that the cost of the voyage Isabella, originally underwrote for Columbus, was approximately $30,000.
This has been considered at least a moderately successful utilization of venture capital. Without attempting to evaluate the psychic income derived from finding a new hemisphere, it must be pointed out that even had squatters' rights prevailed, the whole deal was not exactly another IBM. Figured very roughly, the $30,000 invested at 4% compounded annually would have amounted to something like $2 trillion. That's $2 trillion for those of you who are not government statisticians, by 1962. Historical apologists for the Indians of Manhattan may find refuge in similar calculations. Such fanciful geometric progressions illustrate the value of either living a long time, or compounding your money at a decent rate. I have nothing particularly helpful to say on the former point. The following table indicates the compounded value of $100,000 at 5%, 10% and 15% for 10, 20 and 30 years. It is always startling to see how relatively small differences in rates add up to very significant sums over a period of years. That is why, even though we are shooting for more, we feel that a few percentage points advantage over the Dow is a very worthwhile achievement. It can mean a lot of dollars over a decade or two.
5%, 10%, 15%, 10 years, $162,889, $259,374, $404,553, 20 years, $265,328, $672,748, $1,636,640, 30 years, $432,191, $1,744,930, $6,621,140. Our method of operation, our avenues of investment break down into three categories.
These categories have different behavior characteristics, and the way our money is divided among them will have an important effect on our results, relative to the Dow, in any given year. The actual percentage division among categories is to some degree planned, but to a great extent, accidental, based upon availability factors. The first section consists of generally undervalued securities, hereinafter called generals, where we have nothing to say about corporate policies and no timetable as to when the undervaluation may correct itself. Over the years, this has been our largest category of investment, and more money has been made here than in either of the other categories. We usually have fairly large positions, 5% to 10% of our total assets, in each of 5 or 6 generals, with smaller positions in another 10 or 15. Sometimes these work out very fast, many times they take years. It is difficult at the time of purchase to know any compelling reason why they should appreciate in price. However, because of this lack of glamour or anything pending which might create immediate favorable market action, they are available at very cheap prices. A lot of value can be obtained for the price paid. This substantial excess of value creates a comfortable margin of safety in each transaction. Combining this individual margin of safety with a diversity of commitments creates a most attractive package of safety and appreciation potential. We do not go into these generals with the idea of getting the last nickel, but are usually quite content selling out at some intermediate level between our purchase price and what we regard as fair value to a private owner. Many times generals represent a form of coattail riding, where we feel the dominating stockholder group has plans for the conversion of unprofitable or underutilized assets to a better use. We have done that ourselves in 35 Sanborn and Dempster, but everything else equal, we would rather let others do the work. Obviously, not only do the values have to be ample in a case like this, but we also have to be careful whose coat we are holding. The generals tend to behave market-wise very much in sympathy with the Dow. Just because something is cheap does not mean it is not going to go down. During abrupt downward movements in the market, this segment may very well go down percentage-wise just as much as the Dow. Over a period of years, I believe the generals will outperform the Dow, and during sharply advancing years like 1961. This is the section of our portfolio that turns in the best results. It is, of course, also the most vulnerable in a declining market, and in 1962, not only did we not make any money out of our general category, but I am even doubtful if it did better than the Dow. Our second category consists of workouts. These are securities whose financial results depend on corporate action rather than supply and demand factors created by buyers and sellers of securities. In other words, they are securities with a timetable where we can predict, within reasonable error limits, when we will get how much and what might upset the apple cart. Corporate events such as mergers, liquidations, reorganizations, spin-offs, etc., lead to workouts. An important source in recent years has been sell-outs by oil producers to major integrated oil companies. This category will produce reasonably stable earnings from year to year, to a large extent irrespective of the course of the Dow. Obviously, if we operate throughout a year with a large portion of our portfolio in workouts, we will look extremely good if it turns out to be a declining year for the Dow, or quite bad if it is a strongly advancing year. We were fortunate in that we had a good portion of our portfolio in workouts in 1962. As I have said before, this was not due to any notion on my part as to what the market would do, but rather because I could get more of what I wanted in this category than in the generals. This same concentration in workouts hurt our performance during the market advance in the second half of the year. Over the years, workouts have provided our second largest category. At any given time, we may be in 5 to 10 of these, some just beginning and others in the late stage of their development. I believe in using borrowed money to offset a portion of our workout portfolio, since there is a high degree of safety in this category in terms of both eventual results and intermediate market behavior. For instance, you will note when you receive our audit report that we paid $75,000 of interest to banks and brokers during the year. Since our borrowing was at approximately 5%, this means we had an average of $1,500,000 borrowed from such sources. Since 1962 was a down year in the market, you might think that such borrowing would hurt results. However, all of our loans were to offset workouts, and this category turned in a good profit for the year. Results, excluding the benefits derived from the use of borrowed money, usually fall in the 10% to 20% per annum range. My self-imposed standard limit regarding borrowing is 25% of partnership net worth, although something extraordinary could result in modifying this for a limited period of time. You will note on our year-end balance sheet, part of the audit you will receive, securities sold short totaling some $340,000. Most of this occurred in conjunction with a workout entered into late in the year. In this case, we had very little competition for a period of time and were able to create a 10% or better profit, gross, not annualized, for a few months' tie-up of money. The short sales eliminated the general market risk. The final category is control situations, where we either control the company or take a very large position and attempt to influence policies of the company.